So, hi everybody, this is Hustle Hub. I'm Giacomo, and today I'm going to analyze Palo Alto Networks. This is one of the stocks that you asked me to analyze. So, before we get into the video of today, a few disclaimers. This is not financial advice, so do your own research. And second, the data that I've taken comes from Seeking Alpha and the New York University website, especially for the risk premium estimate that comes from Aswat Damodaran's spreadsheets. So, let's get into the video of today. So, the first assumption is the risk-free rate. I've used as a reference the interest rate swap for 10 years. That is around 4% as of now. So I've taken that as a reference. As I said, the risk premium comes from the spreadsheets of Aswat Damodaran's. And then here's the beta, the last 24 months beta for Palo Alto Networks. Second, we estimate the cost of debt. That is around, as I said, 4%, and then I've put a 2% spread on the debt as a addition to the risk-free rate. So here's the debt to capital ratio and the equity to capital ratio. We can see that Palo Alto Networks is not too much exposed to debt, so that's good. That means it's safe, but probably in better times it could use more debt and use it in order to lower the cost of capital and reward the equity investors with probably a higher return on equity. So here we have the estimates for the weighted average cost of capital, and I estimate it to go down a little bit in the future, given that it's widely expected for the Federal Reserve to cut rates. So yeah, I've taken that into account for the future. So next, here's some highlights for the last 10 years of Palo Alto Networks. So we see that the revenue has grown quite a lot, and the earnings have gone from negative to very, very positive in the last few years, and Palo Alto doesn't seem to slow down, not even a little bit. And we see the free cash flow that has been positive for a lot more years, because probably Palo Alto reinvested quite a lot in research and development. But it has, from as of now, it has paid off, given the growth, the strong growth that it had in a free cash flow. So next, we start making assumptions for the future. If we make an assumption that for the next 2.5-3 years it's going to continue to grow as it did in the last 10 years, I've taken it around 30%, 15% until the end of the year, and then 30% for the following 2 years, and then I cut the growth in half. And then the long-term growth, the rate used for the perpetual growth is 3.1%. That is widely accepted as a good rate for the long run, given that in corporate finance you usually use a growth around the growth of the GDP. So here's the calculation of the terminal value, and we have the present value of the terminal value. Then we add the free cash flows and the terminal value, the present value of that terminal value, and then we subtract a few things that could dilute our value. Here we have the net debt position. That is actually a positive number, because as of now, Palo Alto has a net positive position on cash, and then we subtract the value of the options, of the outstanding options. I haven't done the Black-Scholes model just for simplistic reasons, but yeah, maybe you have between 1 and 2 billion probably in value of options that are very likely to be exercised, almost certain given how good it's performing. And we see that the average weighted average exercise price is around $66, and the current share price is at around 330. So management will quite surely exercise these options. Then we add, we subtract the value of the restricted and performance stock units. This is the estimate for that value, and we subtract all of these values out of the value of what becomes the value of equity. So then we divide it by the outstanding shares as of now, about 300, slightly more than 320 million, and we come up with the value of a single share that is quite higher compared to the current share price. So that makes it for probably a buy. We may make a few assumptions if, for example, the company will not grow as we hope, and we see that the difference between the two is quite trimmed. But yeah, I think that Palo Alto is well positioned, and the current struggles that some of its competitors are facing probably would make it easier for Palo Alto to benefit even more and grow even more. We have seen what has happened at CrowdStrike, and that could possibly benefit the competitors, and one of these competitors is Palo Alto Networks. In this analysis, I haven't gone into the details. I haven't talked about the details of the underlying technology because, first of all, it's not my cup of tea. And if you're interested, you can go in one of my old videos, some of the videos that I've done with the guys from Convequity. And those guys, especially Jordan, is really good at explaining the underlying technology, why he thinks a technology is better than the other, and so on. But also, he is really good at understanding and explaining all the financials because he has a CFA certification, so he's really on point. So I would recommend you, if you're interested, to take a look at the previous videos that I've done with them, with the Convequity guys. Because they definitely deserve attention. You can follow them on Twitter. I'm not getting paid for saying that. I really think they do a great job, and you can see the old videos where Jordan explains the basics, the underlying technology of these cybersecurity companies, especially Palo Alto Networks. So this is it for today. I'm Giacomo. This is Hustle Hub. See you next time, and like, subscribe, and comment with the stocks you would like to see me analyze next. See ya. Have a good day. Bye.